One of the most common questions we get from clients is whether they should invest in real estate directly. And my first question back to them is usually, how long are you investing for? Because the research comparing publicly traded REITs versus direct real estate performance is not often discussed, and it actually surprises many investors. A lot of people assume direct real estate must automatically produce better long-term results because it feels more tangible. They can physically see the property, collect rent, avoid watching prices fluctuate every day on a screen. But when researchers have studied this question over long periods of time, the conclusions have often been very different from what investors expect. A large body of academic research suggests that over the long term, REIT returns and direct real estate returns tend to converge. In other words, while REITs may appear much more volatile in the short run, their long-term price performance increasingly reflects the same underlying real estate fundamentals that drive private property values. One of the biggest reasons for the perceived difference between REITs and direct real estate is something called appraisal smoothing. Private real estate is typically valued through periodic appraisals rather than continuous market pricing. That means property values in private real estate indexes adjust slowly over time. If commercial real estate values fall sharply, appraisals may take months or even years to fully reflect those lower prices. The same thing happens during recoveries when values rise again. This creates the appearance that private real estate is dramatically less volatile. REITs work differently. Because they trade in public markets, investors immediately react to changes in interest rates, rents, occupancy trends, financing conditions, and economic conditions. As a result, REIT prices can move much more dramatically in the short term. But many researchers argue that REITs are not necessarily more volatile because the underlying properties are more volatile. Instead, REITs may simply be reflecting market information faster. So what qualifies as long-term in this research? Generally, studies suggest that REITs can behave more like equities over shorter periods, especially over months or a few years, because investor sentiment and stock market volatility can dominate pricing in the near term. But over periods closer to 7 to 10 years and beyond, the underlying economics of real estate tend to become the primary driver of returns. This is one reason many institutional investors view REITs as a legitimate long-term real estate allocation rather than simply another stock sector. Now, this does not mean that REITs and direct real estate are identical. REITs still have differences including liquidity, public market sentiment, and in many cases the use of leverage. But the broader academic conclusion is that over long enough periods, publicly traded REITs increasingly behave like the underlying real estate they own.